Okay, welcome Tribe. Welcome to Tribe Tuesday, where every Tuesday we go through workshops to build up your fundamentals in investing and also in your financials. Before I get started, again, this is a disclaimer. I'm not a licensed financial advisor. This is not financial advice. It's not a recommendation to buy or sell anything. And I'll be sharing some of my key ideas, some of the things that I may even buy, but please do your own due diligence. If you are okay with that, please comment okay. Meaning to say you will do your due diligence and not just take my ideas and just duplicate like that, because it's not gonna be useful for you. What you want to do is to accumulate the skills, and these skills will serve you for your lifetime and also for your whole entire family. Right. So Investing University, today we are talking about valuation methods. So let me start by this question. Which stock is cheaper? Is it the first one on the left, okay, or the second one on the right? First or second? Just give me your sensing based on the current information that we get, or just type or comment what are your thoughts. Now, actually, I met one of our tribe members just a couple of days ago when I was at a coffee shop drinking my coffee. So this nice gentleman came over and said, wow, he really wanted to learn more about investing. And I asked him, I said, if you don't mind, can I take a look at your portfolio? And I saw a lot of his stocks, right? Stocks that I couldn't recognize. And when I asked him, why did he buy the stocks? He told me, because they are cheap. Okay, because they are cheap. And I asked him, what does he mean by cheap? So when I look at the prices, right, a lot of them are cheap stocks, meaning to say $2, $1. And his theory is this. His theory is if the stock prices is lower, there's more chance of them to double. Now, how many of you agree with this theory? If you agree or it makes sense, it sounds like intuitively it does, like it's relatable, help me type A, meaning to say agree. If you're not disagree, you can type D, or if you're unsure, you can type question mark. Now, so I can see some agree, some disagree. But a lot of times, this is how most of us get started, even myself. Oh, this is only $2. I think for it to become $4 or $5 seems like a higher chance for this stock, let's say $300. Okay, this is the initial kind of thinking. Now, if we look at the financial information, right, we can have a different perspective. So what do I mean by that? Let's take a look at DHA, okay, DHI, sorry. So I'm going to go through some of the financial information. So now, how do we assess whether a stock is cheap or expensive? It is in relation to what are we buying for the stock. So an example is, I tell you there's this two property. This one is for, let's say, $2 million. And this is for only $200,000. Which one is more expensive? Now, a lot of people on first look will say, of course, 2 million is more expensive. And by the way, I'm just talking about comparison in price, and imagine that you can afford both, okay? So which one is more expensive? Most people will just look at the price and say that this is of a higher price, therefore it's more expensive. However, we got to take a look at how big the house is. Imagine this is a very big bungalow, a mansion, 10,000 square feet. Okay, I'm not sure whether is it big or small. 10,000 square feet mansion as compared to this is only 100 square feet. 100 square feet, is it possible? Okay, please pardon me if I got my facts wrong. Okay, so if you look by per square feet, right, in fact, this is a lot cheaper. Okay, so now how do we compare when we look at stocks? You must understand, whenever we look at stocks, we are buying a business. So we got to look at what can this business give us. And in the past few previous recording, I did mention that when we are buying a business, we are buying the future profits. Correct? Because this is, if this business can make me 1 million versus another business can make me $100 per year, the $1 million business is a lot more valuable. Imagine I can buy them at the same price. I would definitely choose that $1 million business. But most of the time, you can't buy them at the same price. So what do we look at? So let me just share with you. This is a DHI, 𝗲𝗏𝗃. Okay, so now I'm not very familiar with these businesses. I'm just showing you valuation measures. So let me give you a few key measures that we look at. Now, the first thing that I like to look at is how much income they are making, net income. And you can see that this business, for the latest record, trailing 12 months, meaning to say we add up the past 12 months net income every single month. Right now is February, correct? So very likely when they show this is probably in December. So December, November, they add up the last 12 months. So the total last 12 months is 4.65 billion. Wow, looks like quite a profitable business. And at the same time, we do not get this whole entire 4.65 billion. We are shareholders if we buy the shares, okay? So if we buy the shares, they will take this 4.65 billion divided by the number of outstanding shares, which is 320 million. So they take this number, 4 over billion divided by 300 million. Every single shareholder, we will get this thing called earnings per share, or income per share, which is 14.34. Take note of this number. So this is 14.34. Now, I'm just going to write some of this number here. 14. Is it 14.34? 14.13, sorry. 14.13. This is how much every single share is making for us. And this is the share price, 126. Now let's compare to this intelligent group and let's see whether it's an intelligent choice to buy this share. So if we look at intelligent group, let's take a look. Their net income is 5.93 million. Wow, so little. Okay, but depends on how many shares they have. Their outstanding shares, if let's say there's only one outstanding shares, that one shareholder will get 5 million, 5.9 million. You can see the outstanding shares is 11 million. So 5 million divided by 11 million is 0.02. Okay, plus dilution. Dilution means sometimes they promise their employees, their CEO, certain like shares, options. Okay, all these will dilute the shares, meaning you say there will be more and more shares out there. So it's about 0.2. Every single share is making us 2 cents. So this is 2 cents. So now, in relation to this, right, in fact, which company is cheaper just based on how much each share has made for the past year? Now, this is something called PE ratio. We take the price, okay, we divide it by the earnings. P, which is equals to the price, divided by the earnings per share, remember, which is $14 here. We take the price divided by the earnings, which is $2 divided by 2.13 divided by 0.02. So let's do a simple calculation. This is a calculation that most of the investors would have done before if you are learn this matrix in some way. Have you learned of PE ratio? If you're familiar with PE ratio, type 1. If you're unfamiliar, type 0. Okay, this is just a starting, like a introduction to what are multiples, but this may or may not be the valuation method that we will use eventually. Oh, quite a number of you are quite familiar. Anybody 0? No. So I'm wasting everyone's time. Okay, so let's go through this. So you can see 126.42 divided by 14.13. Okay, that's about 8.94. Okay, so I'm going to put here 8.94. So in other words, based on how much the share is earning or how much the company is earning, we are paying 8.94 times. Okay, 8.94 times. We are paying 126 for this amount that's earning. And if we assume that this company can continue to earn profitably, 14.13, next year 14.13, okay, every single year 14.13, it takes us 8.94 years to break even. Does it make sense so far? If it makes sense, how many type Y? Y for yes. Now, so this one gives us 8 years to break even. And let's take a look at this. 2.13 divided by 0.02. This will take 100 years to break even. 106 years to break even. Not too bad as well. So now, in relation to these two, once we look at price to earnings ratio, which is cheaper? Can we all agree that it's number 1? If you agree, how many type 1? Okay, so this is how we take a look at things. So this is basically, as I mentioned, called price earnings ratio, PE ratio. So it's the most widely used and misused. And this is an article by NYU. So this university actually talk about like, it is too simple. So because of that, we make a lot of wrong choices. But is it really misused? Can we just use PE ratio? Let me just share with you that there are different multiples. And by the way, this is the outcome. Okay. Anyway, I wanted to just show this. Okay, let me just close some of this tab first. I just want to show this because you can see for this Dr. Horton, if you have bought it like 5 years ago, okay, your money will have grown more than 100%. So you bought it about $50 over, okay, $50. It has grown to $126. I'm not saying that you should do it, but I'm saying that as compared to, let's say, a stock that's $2, by right, this intelligent group now is only 0.9 cents. But if we bought it at $2, and I wanted to show the $2 price because we think that $2 may double easily, but it may also half easily, okay? So it has dropped by half, okay, from $2 all the way to 0.91. So don't just look at the price. Price is what you pay. Value is what you get. This is a famous saying by Warren Buffett and also his teacher, Benjamin Graham. Price is what you pay. Value is what you get. So we must take a look at what are we paying in relation to the value. That's where the idea of multiples comes in. Okay, so what are multiples? These are some of the common and important multiples, and I'll run through with you and show you which are the ones I would use. Okay, so now can you share with me what are some of the key multiples? When we talk about multiples, means how many times, like price to earnings, how many times it takes me to break even, or how many years it takes me to break even. Can you all share with me some other multiples if you all can think of it right now? There's PE is not really my favorite. For those who have been following me for a while, you all know that I like to use this particular multiples. Yeah, price to book, price to sales, very good. Okay, so example, we can ask how many times profits, how many times of profits are we paying for? So example, we are paying for 10 times profits, 20 times profits, 30 times profits. This is typically known as PE ratio, or we use PE ratio to see based on the price we pay, how many times of earnings are we actually paying for. Another one that we use is how many times revenue are we paying for? So price to sales. Typically, we use this for companies that's not making money yet. They are making revenue. However, after paying for everything, they are losing money. Another one we look at is how many times cash. This one is for very cash-rich company. Sometimes people like to use this for banks or for companies that's holding on to a lot of cash. And when you can find companies where the price to cash flow, okay, is extremely attractive. And what is attractive? We'll take a look at it later. This is like a very, I would say, almost like a safe buy. Why? Because if the company closes down, you have enough cash to like take back. Okay. So, and finally, there's also price to book value. Meaning to say this company has a certain amount of net worth. How many times are we buying? So price to book. Now, I have a certain number of years ago, I actually did study and I prefer price to book. But however, over the years, I have evolved and advanced my methods. And so later I'll share with you guys which one do I like better now. Okay, some of you may be surprised. So the reason why I like price to book is because it is very much proven. So what happened is this, I've been taking data for the past 10, 20, 30 years, and I look at the price chart. I look at the price chart of many, many, many companies, done almost 100 over companies. And I want to ask myself, is there a predictor? A predictor. So before the price dip, okay, we want to avoid this, correct? Before the price dip, okay, is there a predictor? Is it PE ratio? Is it price to sales? Is it price to cash, or is it price to book? Which one can tell me that it's overvalued? So I get out before it dips. And then before it goes up, is there a predictor? Which one can tell me that the price is going up? So that's how I did my studies. So over the years, I came to like price to book, relative price to book, which I'll explain in a moment's time. Okay, Ken? Now, so as I mentioned, price multiple is any matrix that uses their like price to book, price to sales, and so on. So, but the question is, are these effective? Are these proven to be effective? So there's this particular paper that I highly encourage you guys to read. If you have not read this, I will put this inside the description of this video or inside the Telegram group, whichever places you're watching this video from. Now, this particular research is done by 𝗲𝗏𝗵𝗃. So they stem from actually even 𝗵𝘀𝗁𝗃, Gene Simons. There's a certain roots to them. So it talks about what has worked in investing. And I love this. It is actually like a work of a quant investor where we take a lot of data and we see, is this proven? So let me share with you some of the key findings that they have. Now, they actually did quite a number of studies. Let me show you the paper instead. I've taken some screenshots, but I think the paper itself will share a lot more. So this is the paper. Again, I'll put the PDF link. You can go and watch it. So they did a lot of studies into different multiples and see whether it has been successful. So they did like talk about how about price to asset value, like book value or current asset value. And they say, how about low price to earnings? Like if I buy stocks with low P ratio versus stocks with a higher P ratio, do I really have an advantage? And they use Benjamin Graham's method and stuff like that. So they also talk about a small caps company, big caps company. And let me share with you guys some of the earnings. Okay, earnings, did I say earnings? Some of the results. So anyway, let me just share with you some very interesting results. Okay, let me go to some of the papers. So what they do is, this is a study done in 1963 all the way to 1990. So how many years is that? Okay, they actually, what they do is every single year on the December, they will consolidate all the stocks in the stock market. So the stocks in the stock market, right? There are those with the different decimal. I mean, you say different like a percentile, okay? So first percentile, second percentile, all the way to 10 percentile or 100 percentile. Okay, so these are the one with the lowest price to book value. You can see the highest price to book value is in column 1. The lowest price to book value is in column 10. Okay, they also further break it down into small caps versus large caps. Okay, so they actually place it, but take a look at this. Okay, take a look at this. So if they take all the large cap companies with high price to book value and they buy it every single year. If they buy the largest cap at the highest price to book value every single year, the top 10 percentile or the top 10%. Okay, for example, let's say this stock market has about 8,000 companies. So they take the top 800 companies with the largest cap and the highest price to book value, and they buy every single year and they hold for 1 year. And next year they sell. Because why? Why do they sell? Because 1 year later, some of the large cap company could have become small cap, right? Because if they drop in price, they'll become small cap. And also their price to book value could have been cheaper. So they will sell away everything and then they will buy again. And they sell away everything and buy again. So every year, they only rebalance their portfolio 1 time, okay, which is on the 31st of December. And what happens is this. If they have done this over and over and over again, from 1963, 1964, 65, 66, 67, 68, all the way to 1990, I think there's about 17 years, is it? Okay, is it 17 or 27 years? Yeah, about 27 years, sorry. If they do this for 27 years, okay, this one from July start. So they rebalance it every, December, they actually started doing this. So about 27 years, what happens is, right, there will be a CAGR of 11.2%. Now, if you can find a method, right, where you do not really need to monitor a lot of things and you can make 11.2% just by a simple method, would that be something that will be like decent for you? If it's decent for you, how many type D? If it's not, it's like 11.2% is too low because my crypto Bitcoin is going by 300%, of course. Okay, so 11.2% is pretty decent. But this is the largest cap with the highest book value. Now, what if you take example, the small cap? Small cap typically has, I would say, more risky, correct? So you can see large cap seems to be a lot more safer as compared to small caps. However, the study shows if you take small cap plus low book value, okay, the lowest book value, if you do this over and over again and recycle it for the past 27 years based on that time period, it will be 23%. Can you see that? So the studies did show, right, a lot of this small cap company, they are small and they are really cheap. And what happens is, right, a lot of them eventually go bust. However, just by buying the top, or rather the smallest 10% of the smallest cap with the cheapest price to book value, right, year after year after year, even those companies that go bust, half of them eventually double, triple by their whole entire price, right? Your whole portfolio would have grown by 23%. How many of you think that 23% is awesome? If you think it's awesome, how many type PB? So price to book value is something that is pretty much proven. Now, we are not saying that we just take price to book value purely by itself. You can do that if you have enough capital to buy the 10% of the stock market, which is a lot, okay? So anyway, you can see regardless which capitalization, it can be small cap all the way to big cap. Can you see? If you actually take the lowest price to book value, worst case scenario, you get about 14.2%, okay? Which is pretty good as well. So low price to book value, it's proven year after year after year in the past. Okay, in the past. Right now, is it still working? Later, I will share with you some variation. No one has actually done a follow-up study and the later one. And a lot of like questions over like, is this method still relevant today? So we'll be answering that. Okay. So this is a price to book. And I mean, I love reading these kind of papers because it's data, and it gives us a lot more like insight into how to actually approach a particular investing theory. Okay. So anyway, not to bore you guys, study was done, and even PE. So if you take like lowest PE versus highest PE, the low PE is always more superior in returns as compared to the high PE companies, regardless of market capitalization. However, you can see that this paper eventually favor small caps. Small caps with low valuation, with also low debt to equity ratio, and quite a number of things. How many of you are interested to read the paper? If you're interested, please type me, and I will share with you guys in a moment's time. Okay, Ken? So, okay, great. So okay, anyway, like share with you guys, small is better. Quite a lot of studies done. So we decided that PE ratio, PB ratio is something that has been effective. However, how do we use it? So I want to share with you, right? Different industry. How do we know a PE is cheap or PE is expensive? Different industry have different multiples. So let me give you some examples. Okay, by the way, this is a quick summary table because I do not want to go into too much details and yeah, you guys lost in translation. Quick like summary table. PE, this is the formula, this is the purpose, measure how much you're willing to pay per dollar of earnings, and it's best used for consistently profitable companies. Now, price to sales, you can see it is for non-profitable company, okay? And cash flow and also a price to book, usually asset heavy company. Okay, got it? So these are the key ideas. Now, let me share with you guys some of the key papers as well. Again, this is by NYU. You can so it is a study done by them. Very cool. So what it shows is right, different industry has different PE ratios. So this is their current PE ratio. Now, how does this help us? Because let's say, example, we want to buy an, let's say a drug company. Okay, you can see that the PE ratio on average is about 53. So you don't be so shocked when you say that, wow, let's say you want to buy, I think it's a coal company, is it? Coal-related company. Can you see coal and related energy company is about 8 point something. So if you see a coal company or a related energy company that has a P ratio of 10, okay, you say, oh, P ratio of 10 is cheap. Actually, it's not cheap in relation to their peers. Can you see that? It is important to cross-check against industry. Okay, but anyway, I'm going to cut to the chase. These are some of the information you all can take a look at. This is for PE ratio, and they take the whole entire industry, they calculate. However, this is my concern. Because based on my experience and as an investor, I'm not sure about you guys as well, some of the categories or some of the companies, right, they are not correctly, I would say, placed into the correct industry. Okay, this what I noticed. Okay, so example, if I go into this company, let's take a look at Google. Companies, when I take a look, it doesn't seem like, or was it Meta? Okay, let's take a look at this. Okay, so Google is placed in the interactive media industry. I don't think it is the correct industry. Let me share with you why. Interactive media industry, right? It is consisting of mostly gaming company. Is Google a gaming company? I don't think so. I think that Google should be in the advertising or maybe the cloud industry. So, but of course, a lot of them as they grow bigger and bigger, and they have a lot more like business segment, it becomes not so, I would say, not so clear. Now, if I take a look at Meta, let's see. Take a look. Guess what? What industry are they in? Meta platforms, Facebook. Oops. So it's very important not to just take a look at industry blindly, but really understand that particular business by itself. So Meta is, it's also an interactive media industry. So it's actually pretty wide. Okay, so but there's also advertisement company, there's also communication company. So this is something that we're going to take note of. Don't just take it as face value. Now, I want to share with you guys how I take a look at these multiples. And zooming straight into it, you can see a few things. So, okay, now, the particular website that I like to take a look at the valuation is Morningstar. So I'm going to use an example of Microsoft. And I'm going to show you guys how I find this page. Okay, I'm going to go here, type Microsoft, or you can type even Microsoft, and then you type Morningstar. This is the easiest way to find the page on Morningstar. So Microsoft, Morningstar, click on this. Now, after you click on this, right, click on valuation. So there are a few things I like to share with you guys, and I'm going to compare this to Microsoft's past prices. Okay, let me close this. Now, let's take a look. If we use multiples, we just use multiples as valuation, is it going to help us buy Microsoft at a better price? Okay, I'm not saying there's no perfect price, correct? Now, so you can see that Microsoft is a pretty strong company. And in fact, because it's a pretty strong company, most of their metrics, most of their like sales, their earnings, their cash flow, their book value per share is very consistent. Let me just show you this. So you can see this is Microsoft, right? So we got revenue per share, we got earnings per share, cash flow per share, and book value per share. Now, Microsoft is almost like a model answer. Why? You can see that from 2016, all the way to 2024. Can you see like their revenue per share is growing steadily? Now, if I click on this, right, you'll see a yellow color line. The yellow color line is basically their revenue per share. Can you see that? It's like a model answer. And do we all agree that because right now, Microsoft, okay, you take a look, okay, I have to go quite a number of things. Because every single share, last time in 2016, every share that we hold, it makes us $11.07. This is based on revenue. The revenue is $11.70. Right now, every single share is making $33. Do you guys all agree that right now, 2024 or 2025, as we speak, the value of each Microsoft share is already higher as compared to 2016, just because they can make more money? Do we guys agree? If agree, help me type A. Okay. So this is the perspective of using this kind of valuation method. And the market, the stock market generally also agree, because you can see that the price is going up. Can you see that? Okay. So now, but when is the better time to buy Microsoft? You can see there are dips here, right? 2022. 2022 is the better time to buy. Why? Because you can see that even through the bear market, they are still making more money. So this is a very big divergence. Can you see that? A very big divergence. And how can we see this kind of divergence? Later, I'll show you guys in a moment's time. So when I talk about divergence, means that the value of the company obviously has not gone down, but the price went down. So this is a good time to buy. It's cheap. This spot itself shows us that there's a discount. Does it make sense, guys? Okay, if it makes sense, you can help me type Y, okay? Just to see that you guys understand. So revenue per share is strong for Microsoft. Earnings per share, okay, you can see is not as stable, okay? But it's actually also pretty good. There are some years it dropped. I think it was 2018. Can you see? 2018 dropped. So this is the time you'll be very confused. Is it cheap? Is it not cheap? The price didn't drop that much, but the earnings dropped. We are not very sure, correct? The P ratio could have gone very, very, very high. So the best time to buy is also here, 2022. So as I mentioned to you guys, Microsoft is very strong in almost every single matrix. Okay, cash flow per share, and also finally, book value per share. Book value per share. Okay, so for Microsoft, are we able to see that in 2022 is a good time to buy? Let's take a look at the valuation matrix of Microsoft using Morningstar. So I'm using 𝗲𝗏 to look at their past data and using Morningstar to check their matrix. Now, let me take a look. Okay, so you just focus on here. Can you see? Let's just focus on the first one, price to sales. So for price to sales, this is Microsoft's price to sales for the past 10 years. And let's take a look and see whether visually are we able to observe when is the time the price to sales shows that Microsoft is undervalued, is cheap. When can you see that? Is it very obvious that you can see this 8.88, which is in 2022? And by the way, this one, they actually measure at the end of 2022. So why is this cheap? It is not because 888 is an auspicious Chinese number. It's because relative, when you go and compare on average by this time period, the market is willing to pay a lot more, 10 over times for their sales. Okay, whatever sales they can make per share, the market has increased the valuation of Microsoft over time to cross 9, 10, 11, 14, then suddenly it's 8.8. So this portion, even without looking at 2023, you can see that it has gone cheap. Is it obvious, guys? Or it's not? I hope that it's obvious. So anyway, later we take a look at right now, is it cheap? Okay. So it's got to be cheap. So we should have bought it at 2022. Now, as I mentioned to you guys, for Microsoft, all their matrix works. So you can see this one, 8.8, 25 is also relatively cheap. 19, also relatively cheap. Price to book 10 is also relatively cheap. If you see that it has been growing, and suddenly there's a dip. Okay. So let's take a look. Any other years is cheap. For price to sales, you may even see that, this one may be a relatively potentially cheap time also. Can you see? 6.8. So if you have bought Microsoft at 2018, let's see at the end, again, December, 2018 is $101. Can you see that? $101. And after that, if you give it a few more months, it will be growing up again. So again, we want the best predictor. The one that tells us that it's cheap, you buy, then it starts to go up. I mean, sometimes we do have to wait, like 2022 December here. $239. After you buy it, okay, it will go up. Okay, again, I dare not say that there's any predictor that shows the super bottom. But if it's relatively cheap, because you must understand, once the price goes down, the price to book, the price to sales, all this will show that it's cheaper already. So we may have bought it maybe somewhere along the way here down, and may take some time to go up. Okay, but again, it's an indication that compared to the past, it's relatively cheap. Okay, so Microsoft is obvious because it's a strong company, and that's why if you have not watched the previous recording, please go and watch, because we do look at all these metrics as well. Okay, like book value per share. We do look at the 10 or 12 actually financial ratios to make sure that we are buying a good company. Now, so Microsoft is one example. Let me show you another example. Let's say called NVIDIA. Okay, so NVIDIA will be a little bit more confusing. Okay, why do I say that? NVIDIA, you can see that their revenue per share looks like this. Boom. Initially it's flat, boom, goes up. What about their earnings per share? Their earnings per share looks like this. Correct. It's a lot more confusing because there are times, certain years, it actually goes down. Now you can see that in 2023, their earnings per share dropped here. Now, my question for you is this. So the earnings per share is 0.17. Can you see 2019 is also 0.17? 0.17, 0.17, 0.17. This is earnings per share. Now, so let me ask you this. If the earnings per share is similar in 2019, 2021, and 2023, if you just look at earnings per share, right, a lot of us, we have concluded that the value of NVIDIA in 2023 has dropped to the same value as 2019. So many will say 1, 2, 3, 4, about. So 1, 2, 3, 4. 4 years from 2019, they have not grown in value. In fact, they have grown a bit, and then after that, their value dropped. But is that true? The answer is like, may not be true, correct? So you can see that we cannot just use one matrix. We're going to use a few matrix to observe. But obviously, 2023, they have been affected almost in all matrix. Can you see that? Okay. Or actually, right, on high side, right, can you take a look, right? Which one is the most stable matrix? Can you see that? Can you let me ask you guys this. Which one is the most stable matrix? To show us that for NVIDIA, 2023, the value didn't drop. So you all take a look. Earnings per share is definitely not a stable matrix. So if earnings per share is not a stable matrix to let us assess whether NVIDIA's value is going up or down, we should not use earnings per share, and therefore P/E ratio is definitely up for NVIDIA. Now let's take a look at cash flow per share. It is actually the same, right? Don't tell me that the cash flow per share dropped until 0.15. You're telling me that NVIDIA's value dropped back to 2019. How about book value per share? Book value per share, I thought it better. Here is 0.9. Okay, it did not drop to past few years' value. It is just lower than 2022. So maybe 2022, the value really went up a lot, and 2023 cannot catch. Now, I think, in my opinion, if I look at this in this way, for NVIDIA, the revenue per share is the most, I would say, stable. Every single year is growing. So even in 2023, the rest of the results slow down, but they show that their earnings power, their ability to make income is still there. So you got to look at the stability of which matrix you're using for which company. Now, every company is slightly different, because if I'm going to use Berkshire Hathaway, you'll be shocked that their earnings per share may not be stable. So let me just show you guys this. So I have come to actually realize that different companies require different ways of looking at the multiples. Let's take a look. Oops, they don't have all the data here. But you can see that the earnings per share of Berkshire is very, very unstable. Can you see that? Where else for Berkshire, if you have used a price to a book value, it'll be a lot more stable. So you must use the denominator that is a lot more stable for companies that is growing and is steady. Does it make sense? Okay. Or BRK has some unknown error. Okay, so maybe we can use another. I mean, I got other platforms that can look at their past 10 years data. But this is the thing that I'm trying to tell you guys. We got to use a more stable denominator. Okay, so now let's take a look at Tesla. Tesla, same thing. Okay, which one is the most stable denominator? Is it revenue? Is it earnings? Is it cash flow? Now, cash flow immediately, because there's like missing information, there's negative portion, it can almost be written off already. It went up, here is a gap, and then it went down. Again, we need more data. Okay, you can see the earnings per share is terrible. Okay, not say terrible lah, but you see, same thing, this year it dropped a lot. Does it mean that Tesla's value actually dropped a lot? For revenue, quite interesting. Revenue is becoming flat. What does it tell you about Tesla? Is it becoming less valuable this year, or is it the same value as last year? So if you believe that the value is not growing, you should not invest into it. For me, for Tesla, I observed that their book value is a lot more stable. And this is very useful, especially in the earlier years. Can you see they are still losing money? In the earlier years, up to 2019, they are losing money. And you think that, wow, but this is a very valuable, super awesome company. But I can never buy it if I'm looking at just earnings per share, right? Because the P ratio will have been negative. So, okay, let's take a look. So for Tesla, in the earlier years, there is no P ratio. So how can you buy a company there's no P ratio? How do I evaluate this? It's going to be so confusing. However, if you look at, let's say, book value, price to book value for Tesla, can you see that, okay, when is the best time to buy? Let's say you are looking at Tesla 2015, 2016, 2017, 2018. Okay, this is on high side. We definitely know that this is on high side. But if you take a look at this, when will be the best time to buy Tesla? 2022 is the best time to buy everything, right? So this is really on high side. But let's take a look at the earlier years. Maybe I would say 2017, correct? But again, we do not have enough previous data, 2014, 2013, but you have seen that 2017, the price to book value is relatively low. Even 2016, it is half of the previous year, you know. So from $23, 23.29 times book value, it dropped to half. Meaning you say the price is like half price right now. So let's take a look at Tesla. 2016. Would it have been? Okay, we don't have the previous data. But you can see that 2016, if we have bought, it will gone up to $20. And then when will be the best time to exit? Same thing. You can see that it grows up all the way here, suddenly 41, right? From 12, the book value 12 goes to 41. This is a warning sign. Can you see that? It is a very abnormal jump. Now, you must understand this is price to book. This is price to book. So the Tesla's book value, in fact, they also jump, you know, but the price jumps even a lot more higher than the book value. So later I'll give you guys an overview. If in case you still don't know what I'm talking about, the key thing is we want the most stable denominator. The most stable denominator. What do I mean by denominator? Denominator, right, means that we take price. Price is the one that's going to divide by the denominator. So the one that we are going to actually use as a benchmark must be very stable because price fluctuate a lot. However, if the value of the book value can show that Tesla is steadily going up, we want to buy it when it is the cheapest relative to the book value. So you can see here for Tesla, it will be let's say about 2017, 2022. Wow, this one you should have sold your whole house and go and sell all your Bitcoin to go and buy Tesla. I'm just joking. Remember the position size. So 2022 December is one of the best time to buy a lot of things. Let's take a look at right now. So how do we know whether now is a good time to buy? Okay, we will know whether Tesla is it relatively a good time to buy by looking at the past few average. So right now, the 5 years average is 17.33. And then right now, Tesla is 14.58. The valuation doesn't look too bad. But do take note that the valuation, this 17.33, consists of 1, 2, 3, 4, 5 years. So if you want to be conservative, you can take away, let's say, this year or this year. But otherwise, you can take a look. Well, Tesla is at least, I would say, fairly valued. Now, that being said, right, let me show you for every single stock, right, it is like pretty much confusing. Like, so exactly which one do I use? Do I go to, let's say, 𝗲𝗏? Do I click on every single one of them and then check? Because sometimes after looking at the line, I'm still not very sure. So I'm going to use a statistical way to have a confirmation. So what is a statistical way? Okay, so let me show you guys this particular valuation multiples, or I call it the optimal multiple. We want to check out which one is the one that's most suitable to use for that particular stock. So later, if you all see that this is useful, you all want this spreadsheet, also let me know. So now, let me give you an example. Let me go back to Microsoft. How to use this spreadsheet? You can see that this spreadsheet is a copy and paste from Morningstar. Okay, calendar, price to sales, price to earnings, price cash flow, price to book. You can see here. Calendar, price to sales, cash flow, book. So what you need to do is to go to this particular table. Later we can test out another stocks, okay? So you mouse over this one, the index, from all the way to the index, mouse all the way up and all the way left until you reach calendar. Okay, later we'll do a few more demonstration. Copy, come here, and then go to this calendar box and then paste. Paste. Oops. Paste. Okay. So after I paste it, let me just do a confirmation that all these numbers are correct, because sometimes it may run. Is it correct? 4.6. Wait now. 4.6. Okay, 4.6. Check a few numbers for 20155. Okay, so you can see the numbers correct. 2015 is 5. So my calculator on my spreadsheet shows that it's 5. So it's right. Now, let me show you what does this calculator do. So make sure you copy and paste within this particular segment, and this will be the calculation. So this calculation, you can see that this is called standard deviation. Now, for those who are interested in creating your own spreadsheet, feel free to mouse over this yellow color box. Please don't touch the yellow color box, it's calculated for you. They will calculate the standard deviation from B4, which is this cell, all the way to here. Now, I take the past 10 years, I do not take the current one. So I look at the standard deviation. Standard deviation means that based on this particular range of stocks movement, how much are they fluctuating? So 3.2, and then standard deviation of price to earnings, and so on. So after taking the standard deviation, this particular portion is taking the mean. The mean means like the average. So now, after that, I will take the average movement divided by the standard deviation. This is the coefficient of variation. So the higher the variation, meaning you say the less stable it is. Now, interestingly, can you see for Microsoft, we want to, okay, for every stocks, we want to take the one with the least variation. Okay, least variation. So let's take a look. Let's confirm the numbers. So yes, so which one is the most stable variation and coefficient? Can you all see for Microsoft? Anybody can see? Yes, the lowest is actually P ratio. So it doesn't mean that P ratio cannot be used for everyone, you know. So in fact, for Microsoft, P ratio is seemingly the best. It's the most stable. Now, what does it mean? It means that over the years, the market, the stock market, likes to use P ratio as the main valuation method to valuate Microsoft. So if Microsoft is making a lot more earnings this year, example, you can see P, yeah. So the earnings per share, as the earnings per share go from $2.50 to $3.25 to $2.13, right? The price will go up and down, according to the number of times of the P ratio. Meaning you say, you can see over the years, it's about 30 something times, 20 something times, 40 something times, and it's quite stable. It is relatively stable as compared to the rest. Example, you see price to sales, sometimes can be 5, sometimes can be 11, sometimes can be 14. The variation is a lot more bigger. We want the one with the least variation, so P ratio has the least variation, and then we buy it when it's really cheap. Because the market generally pays about, okay, on average 30 over times for Microsoft. Does it make sense? So when do we want to buy? We want to buy it when it's below 30 times. When it's below 33 times. There's a time, oh, good. So we can buy them at 2017. We can buy it at 2022. Right now, it is slightly cheaper than average, but not really very cheap. Does it make sense? Does it make sense, guys? Okay, if it makes sense, am I making sense? I hope that I don't confuse you guys. Now, can you guys actually share with me maybe 1 or 2 stocks that you think that is valuable, and we go through the exercise together? So for those who have not watched the previous videos, later I'll give you guys the playlist. Okay, the playlist is under Tribe Tuesday. Please go and watch the previous like investing university videos where we talk about. Hey guys, welcome to Tribe Tuesday and this segment where we talk about like go through the episodes. Okay, investing, cash flow statement, and we talk about the financial ratios. Let's see any particular companies you want to take a look at. Oracle. Okay, let's take a look. Oracle. Oh, 𝗲𝗶 is controversial because it's like I would say a Chinese company, so it's a lot more political. So obviously, it's not a magic bullet that works for everything. But I love that you guys actually come up with all these ideas. Okay, let's take a look at Oracle, and quickly let's take a look at their financial ratios first. So Oracle, from let's take a look. Now, these are the important points also, correct? Revenue per share, wow, very stable. Earnings per share, not as stable. Cash flow per share, decent, it is positive, but also not growing. Book value per share, wow, interesting. This is a very interesting company. Their book value per share actually goes down over the years. I find this a little bit concerning unless they have done a lot of acquisition and they buy a lot of companies at a high value. But it's okay. Let's assume that they are a decent company. But straight away, when you look at Oracle, it doesn't seem like they have the ability to grow. Let's take a look at earnings. Can you see the net income? After many, many years, it is still like pretty flat. So there are quite a lot of, I would say, it doesn't seem like a growth company anymore. Okay, but again, let's take a look at, doesn't mean that we cannot buy. We can still buy a flat company, a company that is strong, just that it's not growing. We can still buy it at a good price, you know. So if you buy a strong company at a good price, like maybe even Coca-Cola, it's not growing that much at a good price, well, you can still make a good profit. Again, like was it Howard Marks or cannot remember which investors that say that there's no bad company that cannot be cheap enough. So you can buy a company that's cheap enough, maybe you can invest as well. But again, make sure that it's within your investing philosophy. Okay, so let's take a look. For Oracle, valuation from price to book here, 4.64, all the way, scroll all the way down to calendar. Okay, copy calendar, come here, paste at the calendar portion, change. Okay, so let's take a look. Their best code is cash flow. Okay, so it seems like the best valuation method will be cash flow for Oracle. But let's take a look. Okay, there's for price book, there's quite a number of missing information. So it's very disrupted. Okay, yeah, because their price to book is terrible, right? We saw that. Their book value is terrible. So you can see that their variation is too high already. Oh no, actually price to sales, sorry. So for Oracle, their price to sales will be the best valuation method. Let's double check. So for Oracle, let's take a look. Their price to sales, 5 years average is 5.68. Current one, this one obviously now is overvalued, correct? If we just based on price to sales. So when should we have bought it? Okay, 2022 is a given already. It's a bit boring now. Everybody knows that 2022 is the correct answer. But is there other places that, okay, so example, should we have bought at 2017? Answer is no. Should we have bought at 2021? The answer is no. Let's see whether is it something that gives us a good predictor. So 2017, 2021, 2017, oh, it's a little, I would say, because the price here is a lot, right? So 2017, if we have bought at, let's say, December, $47, it will have gone, you can see it's gone flat. In 2018, it's still 47. It doesn't grow a lot. So this is the issue when it's overpriced. It will either go flat or even go down. So another time we shouldn't have bought is 20. So you can see 4 point something, 5 point something, 2021, obviously overvalue. Okay, okay, but this one is a little bit unfair because we know by now that 2022 it will go down. Okay, so you can see 2021, oh, too expensive, shouldn't have bought, correct? And then it went down. But although it's on high side, but it's very obvious even when we look at the data. Does it make sense? Is it very obvious? It's gone up. I mean, if it's on average, it's about 5 point something, 4 point something, you should never have bought here. It's a good predictor to tell you that things are overvalued. Cool so far? How many find it useful? Okay, so this is what I want to share with you guys today. So this is the way that I like to use it. I like to know which multiple is the best one, the most optimal to use for that particular stock. Again, we don't do valuation on stocks that is like terrible. They are losing money every year. Their book value is going down every year. No point doing a valuation on that. So we always go back and find good companies first. Their finances are good. Then we go ahead and take a look at their valuation and see which one is the best one to use. This is a simple multiple, but frankly, for me, it is very, very useful. Okay, so I will give you guys this link. I mean, since you guys are here now, let me share with you the link. So remember, if let's say you're not able to enter because too many people are sharing, don't worry, later you can go to the description of this video or go to the Telegram group to get it. Okay, now remember to make a copy, go to File, make a copy. So once you make a copy, you are able to copy and paste the information. Okay, play around with it. Make sure you don't touch these yellow color boxes. Cool. So this is the key thing I want to share with you guys. Now, again, a lot of things to share this week, but I'm not going to go into too much details. Hope that you guys have learned something about valuation. This is my sincere opinion. I know that it sounds a little bit simple, but I do use it to evaluate the stocks that I buy. doesn't mean that I'm always right. Okay, in fact, I make a lot of mistakes. I make a ton of mistakes. That's why position size is very important. So now, a quick sneak preview for next week. This is valuation method number 1. Next week, valuation method number 2. We will go into more industrial or institutional ways of valuating. So next week, I'll be showing you guys some more calculators, which is a relative value target price calculator and also discounted cash flow valuation. So there are a number of valuation, and these calculators I have already prepared for you guys. Just that next week after the lecture, I'll be actually sending to you guys this. Okay, cool. So if you guys enjoy this, remember to join the Telegram group, share with your friends. Okay, I mean, frankly speaking, even if you all don't share the source, like you don't need to actually tell the friends or come and join next level. Don't need. But if you think that this idea is good, please tell people about the idea of valuation. I've met a lot of people who buy stocks and just because they think it's cheap because it's a low price and they burn their whole portfolio. I'm trying to prevent that from happening. So do help me on the mission. Go and share with your friends. I'm not saying that they must join next level, but if you think it's useful, I'll get them to join this tribe. Whatever that we share on Tribe Tuesday is free. So that's all I want to share this particular week. Again, invest safely, do your due diligence. Investing is something that requires work, but once it's done, you find a good one, you find a good stock, it will last you for a while, but that doesn't mean it will last you forever. Continue to monitor it, continue to rebalance your portfolio, and continue to position size. All right, I'll see you guys next week. I'll put the recording into the Telegram group soon. All right, bye-bye.